Hey everybody, so I just wanted to explain to you my thesis in the markets here. So let's just think about our current situation. So our current situation, we are currently seeing the Fed funds rate continuously increase. But eventually, sometime in the very near future, this could even be this year, it could be early next year, or it could be late next year. We're going to see rate cuts because we all know that this economy cannot sustain these high interest rates. So eventually we're going to see rate cuts. So what do you think is going to happen when that actually happens? You're probably going to see people flocking towards long-term yields. So, this could be something like the 10-year yield. If interest rates are all of a sudden going to start falling, you're going to see people looking to grab longer term yields because think about it. If you're looking at a T bill is essentially just yield that you're going to get that's under 1 year. So, yeah, the T bills might be high right now. You might be getting like 4.75% interest, but that's not going to last for long. Now, let's go ahead and just look at these yields here. So if I'm looking at the 2-year treasury, you're getting about 4.5%. But keep in mind, when you buy a 2-year treasury, you're getting interest for 2 years. And then after that, it matures. And then, if you were to get a new issuance 2 years later, that interest, that yield might not be as good. So this is a very short-term thing. Now, let's go ahead and look at a 10-year yield. So a 10-year yield, this is locking it in for a longer period of time. So the interest is a little bit lower. So your yield is like 3.74. So if you're investing in equities and we're predicting, a pretty bad recession in the future, then, it might be a good idea to lock in some longer term yields, or it might be a good idea to wait for a lot of dividend stocks to fall to a level where the dividend yield is attractive enough to buy. So, let's just go ahead and talk about one dividend ETF in particular. Now, I'm not necessarily saying go out and buy this right now. Actually, the opposite. I'm saying don't go out and buy this right now. Wait for the yields to get better. So right now we're looking at DVY. It is iShares Select Dividend ETF. So right now, it's trading at, let's see, 124.65 is what we're trading at. So if we're just looking at this, for the most part, it's remained relatively steady. So right here, we did see a pretty major dip over in October, and that was probably a really, really good buy. So let's just go ahead and look at this right now. So if we're looking at DVY, the dividend history, it pays a yield of 3.36%. Now here we can see a history of the dividend yield and just the payout. So if I were to actually pull out an Excel spreadsheet, which is right here, I could look at just basically the past 4 payouts, which represents 1 year. So the last 4 payouts, it was $4.14. 4 payouts prior to that was $3.82. 4 payouts prior to that, $3.52. And then guess what? 2019, it was $3.60. So in 2019, it was actually higher. But this makes sense because you have to remember what happened in 2020. Now, this specific ETF has quite a few energy stocks in it. So you can understand why this dividend didn't grow in 2020. But what we can see in the longer term, in the last few years, we're seeing the dividend increase. So this is a good thing. You want to see dividend increase. And we all know that energy companies right now, they're paying more dividends, they're doing more buybacks. They're in a good situation. They didn't get wrecked like tech did in 2022. Quite the contrary. So, we can go over to the actual website, the iShares Select Dividend ETF, and just look at some more information about it. So going up here, we can see something called an expense ratio. Now, let me explain what an expense ratio is. So essentially, an expense ratio is basically the firm's expenses to run this fund. So the way that they do it is that they're going to take off 0.38% from the assets under management. So if we're looking at that net assets of the fund, what they're going to do is that they are going to take 0.38%, which is a fraction of 1%, of this amount, then they divide it by the shares outstanding. And then the way that they actually take out this expense is that they take it away from the closing price. And they will do this, maybe monthly or maybe quarterly. But, this is essentially what happens. So let's just do a rough calculation of what that would actually be if we were to just take it all out at once. So let's do 0.0038. And then we're going to multiply that by the funds in management. So let's go ahead and find that again. Maybe I scrolled past it right there. So we're going to multiply that by 23,450,519,690. And then we're going to divide it by the shares outstanding. So, basically, roughly at this point in time, you can expect that they're going to take about 47 cents out of the entire share price. So, if you were to own maybe 100 shares, then yeah, that's about like 47 bucks. Now, is that high? It might be high. I mean, there are some other ETFs that charge a much lower expense fee. But you have to keep in mind that if you're going to own dividend stocks, you're not going to put all your eggs in one basket. That's a silly thing to do because when you're thinking about dividends, you want to get a safe return. So you want to be highly, highly diversified. So maybe this ETF, let's just look at how they're diversified. So this ETF, let's see. So if we're just looking at their holdings, they have energy, they have healthcare, they have consumer staples. And then let's go down the line. They have materials, utilities, financials. And I'm sure somewhere here they're going to have a breakdown, which is right here. So we can see they're mostly into utilities, financials, blah, 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 blah. So maybe, maybe we want to diversify a little bit. Maybe we also want to pick up something like a REIT ETF to give us some real estate exposure. So like I said, we're not going to want to put all our eggs in one basket. Maybe even we want to invest in something like a tech ETF because obviously, we don't just want all dividends. Maybe we want to see some share price appreciation, which we can see from the tech industry. So if tech stocks were to fall big time, it might not be a bad idea to pick up some tech ETFs because that way you could be receiving some dividends while you wait. And then if you picked up some tech ETFs on the low, then on the rebound, you could get share price appreciation. While at the same time, you get basically dividend payments. But like I said, you want your dividend payments to be pretty decent. So we have to pay attention to what the actual yields are, the treasury yields. So if my time frame is very short in dividend investing and it's only going to be something like 2 years, well then I better hope that my dividend yield is higher than a 2-year treasury. Otherwise, I may as well just get a 2-year treasury. Especially if we're assuming that the economy is not going to be good and that we're going to enter a recession. So if we're going to enter a recession, you're likely going to see equities fall. And when equities fall, the dividend yield goes up because you have to remember what a dividend yield is. Yield is essentially the dividend that you receive. So if I received $4 and the share price is 100, then what is my yield? It's basically 4 divided by 100. So that's 4%. So essentially, if the share price is falling, then my yield will go up. So what if the dividend was $4 and the share price fell down to 90? Then guess what? My dividend yield is 4.44%. So if we are expecting a bad recession to come over, then yeah, you're going to see dividend yields across the board go up, but not necessarily in treasuries. So, what affects the treasuries, that's going to be the Fed funds rate. So whether they increase it or they cut it. Now, how does a higher Fed funds rate affect dividend stocks? Most likely it affects it negatively, because if we could get a 5%, let's say that the 2-year treasury was to go to 5%, then yeah, that means I could get 5% risk-free yield. Why would I want to put my money in a dinky little ETF fund that's basically going to give me a 3.36% dividend yield when I could get risk-free interest rates of 5%? That just doesn't make sense. So what you end up seeing is you see the share prices go down to reflect a higher dividend yield. So that's what you see. Now, what do you think happens on the flip side? What if treasury yields go down? So if this went down to like 2%, then where are people going to start looking for yields? They might go into equities, and they might be looking at a stock like a ticker like DVY. What happens if DVY is offering, let's say, like 5% dividend yields at a time when you're going to see interest rate cuts? Then you're going to start seeing people crowd into these ETFs, these dividend ETFs that are paying solid yields at a pretty safe in a pretty safe manner. So then you're going to see all these people run into this. Then you're going to see the price of DVY go up, and then you're going to see the yield go down. Because remember, yield is dependent on the price and the dividend that's actually paid out. So what I'm saying right now is, when you're looking at a dividend ETF, maybe like one like DVY, right now might not be the best time to get in. You might want to wait until you see dividend yields that are, somewhat closer to the 10-year treasury or even higher. So if DVY were to offer something like a 4% dividend yield, then yeah, I might want to start nibbling into that position. But at the same time, like I said before, I don't want to be putting all my eggs into one basket. I might want several different dividend ETF funds. So if DVY were to give me 4%, and if something else were to give me 3%, and if another thing were to give me like 2%, then, I would average out somewhere around 3%, assuming that, I'm allocating it all the same. So you have to be thinking about a lot of different things. Also, another thing that I like to look at is basically, if I'm going right here, pretty much just the assets in the holding. So right here, we can see their top holding is Valero. And then it's followed by Gilead. So if I were to look at Valero's dividend yield, right now it's sitting at 2.9%. So to me, that's pretty low. And Valero has done pretty darn well. And as we can see right here, it's in the energy sector. So maybe I want to see a decent pullback in this, and I want to see the yields pick up here, because if the top holding is only offering 2.9%, then, and when the United States 10-year is offering 3.74, then maybe we could see some maybe we could see the price of Valero actually fall down a little bit, maybe a decent pullback, and then we could see dividend yields here a little bit higher. So I do like to look at these things as well. So basically, to summarize this all up, we want to look at the 10-year, assuming that we're investing for a long period of time, and we would preferably want our yields in our dividend ETF to be higher than the 10-year. Now, if we're investing for a short period of time, we would want it to be similar to the 2-year, maybe even better. So it all depends on your time frame. And it depends on your risk as well, because maybe you just might want to put all your eggs in this one basket. Or maybe you might want to think about what I said earlier and, possibly put it into a REIT ETF, or maybe even diversify a little bit into a tech ETF, so that you can get that share price appreciation for when the stock market actually does recover out of a recession. So I hope you guys enjoyed this video, and have a great one.